Welcome to today's Explainer. Have you ever looked at the global economy and just thought, are financial markets operating in a completely alternate universe? Well, today we're going to dive right into one of the most bizarre contradictions in modern finance. It's a phenomenon where terrible economic news actually triggers massive worldwide wealth generation. It sounds entirely backwards, I know, but by the end of our time together today, you'll understand exactly how this financial magic trick actually works. Okay, let's dive into this. Here is our structured roadmap for untangling this economic mystery step by step. First, the stock market paradox. 2, decoding the NFP data. 3, the interest rate connection. 4, expected versus actual numbers. And finally, the global market reaction.
All right, Section 1, the stock market paradox.
You know, as human beings, our brains really struggle with illogical outcomes. We are wired to believe that a strong, healthy economy should obviously mean a strong, healthy stock market, right? But the financial markets, they don't always play by those rules. Which brings us to a massive puzzle. Why did terrible economic news cause a massive market boom? On July 2nd, data was released revealing a severely struggling U.S. job market. From an everyday perspective, this was a clear sign of economic weakness. More people unemployed, less money circulating. Yet investors didn't panic. In fact, they practically celebrated. And this brilliantly illustrates the paradox we are examining today. In our daily reality, we had incredibly weak job growth, only 57,000 new jobs created in the entire United States. Yet over on Wall Street, we saw surging global stock markets responding to that exact same data point. It's a stark contrast between Main Street reality and Wall Street reaction. To understand why, we really need to look at the exact metric that was released.
Moving to Section 2, decoding the NFP data.
So what exactly is this metric that has the power to shift global markets in a matter of seconds? Well, it's called non-farm payrolls, or NFP for short. It's a crucial metric representing the net total number of new jobs created in the United States during the previous month. Think of the NFP as the ultimate health check for the U.S. economy. The logic is simple. More jobs usually mean people have more money, which leads to more consumer spending, buying houses, buying cars, which ultimately creates a thriving country. It also gives us a really clear picture of the unemployment rate and average hourly earnings. But you might be wondering, why is it called non-farm? Well, when calculating this specific job count, the government excludes several categories to get a clearer picture of industrial and corporate growth. So they leave out farm workers, private household employees, nonprofit organization employees, and individuals who are self-employed. The data focuses squarely on the remaining workforce to gauge the core economic engine. Now, this data isn't just dropped randomly. It's highly anticipated because it's released strictly on the first Friday of every new month. Investors literally mark their calendars for it. However, the data we're looking at from July 2nd was a rare exception. Because the Friday fell on a U.S. holiday, the release was actually pushed up to Thursday. And let me tell you, the whole world was watching, waiting to see if the U.S. economy was speeding up or slowing down.
Let's get into Section 3, the interest rate connection.
Let's move on and see how this builds. Because to understand why bad news works in reverse, we have to introduce the puppet master working behind the scenes of the economy, the U.S. Federal Reserve, America's central bank. Let's walk through this crucial cause and effect chain reaction that they trigger. Step 1, weak jobs data is released. Step 2, this weak data creates immense pressure on the Federal Reserve. The Fed uses this NFP data to decide whether to increase, lower, or maintain interest rates. Step 3, because jobs are low, the market anticipates the Fed will step in to save the day with potential interest rate cuts to stimulate the economy. And step 4, interest rate cuts mean cheaper loans. Cheaper loans mean factories can expand and businesses can borrow money easily. This massive influx of anticipated cash flow into the economy is exactly what triggers the market boom.
Which leads us to Section 4, expected vs. actual numbers.
To truly understand the market's reaction, we have to look at the massive gap between expectations and reality, because that's where fortunes are made and lost. To set the stage, let's look at the previous month's data. Everyone expected 85,000 jobs to be created, but the actual number came in at a staggering 172,000 jobs. The economy wasn't just healthy, it was running extremely hot. On paper, doubling job expectations sounds fantastic, right?
But remember our paradox. Because the data was so strong, it meant the Federal Reserve had zero reason to cut interest rates. Borrowing money was going to remain expensive. As a direct result of this quote-unquote good economic news, the U.S. market severely collapsed. The main market crashed around 800 points, and the tech-heavy NASDAQ dropped 400 to 500 points. For 3 consecutive data releases, the market suffered because the economy was just too strong, creating a frustrating hat trick for investors who desperately wanted lower rates.
Now, what's really interesting about this slide is the total reversal we saw on July 2nd. This time, the expectation was 114,000 new jobs, but the actual data came in at an abysmal 57,000, exactly half of what was expected. From an economic health standpoint, this was terrible. But for the stock market, this was the golden ticket they had been waiting for. It sounds crazy, but this quote perfectly summarizes the core thesis of our explainer today, completely resolving the paradox for us. Fewer jobs created means the central bank is pressured to cut interest rates to stimulate the economy, bringing massive cash flow into the markets. The bears, who bet against the market expecting another strong jobs report, were entirely caught off guard. The bulls took total control.
Finally, Section 5, the global market reaction.
The exact second that poor jobs data was published, a live worldwide ripple effect occurred. U.S. market futures surged instantly, jumping 266 points like a rocket. The Nasdaq futures, which were previously trading in the red, experienced an instant reversal, printing green candlesticks. But it wasn't just traditional stocks. Safe haven metals spiked too. Gold rallied upward by 2%, and silver jumped 3.5%, breaking right through the 60 mark. Even the crypto markets felt the wave, with Ethereum jumping 4 to 5%. Over in India, the Gift Nifty rose 40 points, crossing the 24,300 level. Across every major asset class, buyers completely overpowered sellers in anticipation of rate cuts. So the crucial point is this. All of this global wealth generation pivoted entirely on the tiny number of 57,000 working Americans. Because fewer people found jobs, the entire global financial system priced in cheaper money from the Federal Reserve, and global wealth generation simply skyrocketed. It's a fascinating, almost backwards system where, right now, bad news is good news, but it leaves us with an incredibly important, provocative question to close on today. Can the stock market keep rising indefinitely if the underlying economy continues to slow down? At what point does a struggling Main Street finally pull down Wall Street? Thank you for joining me for this explainer. Keep learning, keep questioning, and let's keep exploring these incredible mysteries together.